Welcome to the chapter on financial statements. Understanding financial statements is essential for analyzing the financial health and performance of a business. In this chapter, we will cover the balance sheet, income statement, and statement of cash flows. The balance sheet provides a snapshot of a company's financial position at a specific point in time. It shows what the company owns, what it owes, and the shareholders' equity. The fundamental equation that the balance sheet is based on is assets equal liabilities plus shareholders' equity. The balance sheet is divided into three main components: assets, liabilities, and shareholders' equity. Assets are resources owned by the company that are expected to bring future economic benefits. Current assets include cash, accounts receivable, and inventory, while non-current assets include property, plant, equipment, and intangible assets like patents. Liabilities are obligations that the company needs to pay in the future. Current liabilities include accounts payable, short-term loans, and accrued expenses, while non-current liabilities include long-term debt and deferred tax liabilities. Shareholders' equity is the residual interest in the assets of the company after deducting liabilities. It represents the owner's claim on the company's assets. Here is an example of a simplified balance sheet. The company has current assets of $50,000 and non-current assets of $150,000, making the total assets $200,000. The current liabilities are $30,000 and non-current liabilities are $70,000, making the total liabilities $100,000. The shareholders' equity is $100,000. The income statement, also known as the profit and loss statement, shows the company's financial performance over a specific period. It summarizes the revenues and expenses resulting in net income or loss for the period. The basic structure of the income statement is net income equals revenues minus expenses. The income statement includes revenues such as sales revenue and service revenue, and expenses such as the cost of goods sold, operating expenses, and interest expenses. Net income is the profit or loss after all revenues and expenses have been accounted for. Here is an example of a simplified income statement. The company has revenues of $120,000. The cost of goods sold is $50,000. Operating expenses are $30,000, and interest expense is $5,000. Making the total expenses $85,000. The net income is $35,000. The statement of cash flows provides information about the cash inflows and outflows over a specific period. It helps users understand how the company generates and uses cash. The statement of cash flows is divided into three main sections: operating activities, investing activities, and financing activities. Operating activities include cash flows from the primary revenue-generating activities of the company. Examples include cash receipts from sales and cash payments for goods and services. Investing activities include cash flows from the acquisition and disposal of long-term assets and investments. Examples include cash payments for purchasing equipment and cash receipts from selling investments. Financing activities include cash flows from transactions with the company's owners and creditors. Examples include cash receipts from issuing shares and cash payments for repaying loans. Here is an example of a simplified statement of cash flows. The company has cash receipts from customers of $130,000, cash payments to suppliers of $70,000, and cash payments for operating expenses of $20,000, resulting in net cash provided by operating activities of $40,000. The purchase of equipment is $15,000, and the sale of investments is $5,000, resulting in net cash used in investing activities of $10,000. The issuance of shares is $20,000, and the repayment of loans is $10,000. Resulting in net cash provided by financing activities of $10,000. The net increase in cash is $40,000, with cash at the beginning of the period being $10,000 and cash at the end of the period being $50,000. This concludes our chapter on financial statements. Understanding these financial statements is crucial for analyzing a company's financial health and making informed business decisions. Thank you for watching.